Hi everyone, this is Paul Fouché, Chief Investment Officer at New Road Capital, giving you your January market update. So quite a busy month, noisy month, geopolitically, you could say. We had Trump's inauguration, so a lot of uncertainty around, Trump coming onto the fold, what he's going to do with trade policy, what he's going to do with tariffs and things like that he's been given. It'll be interesting to see what all the trade rhetoric does. And then if you look at locally as well, you had Ramaphosa signing the EWC bill into law. It's now an act. And yeah, just a little bit of noise around that. But despite all the noise, equity markets actually still did very well through the month of January. If you look at the local all share, up 2.3%. If you look at the MSCI World, which is your developed market equities, up 3.6%. And then emerging markets globally also up 1.8% in dollars. So across the board, pretty much good equity returns. If we look at inflation in the US, ticked up slightly, but we still think, we've done a lot of spoken to our advisor base a lot about our views on inflation and where it's going. And there's still some lagging indicators that make up that inflation number in the US that we think need to come off, and will cause inflation to drop a bit. Our view around Trump's tariffs is that his tariffs are not necessarily going to be inflationary for the US, and we think probably a neutral outcome there. So, a lot of the media and a lot of investors saying, well, the tariffs should be inflationary, but they're not looking. They're looking at the demand side, but they're not really looking at the supply side. Inputs into that equation, and you could argue that tax cuts, corporate tax cuts, improved energy prices. If they are going to open up natural gas, so you got energy prices coming down, and then just opening up of US manufacturing, that's actually going to be all deflationary. So on a net basis, we think if you look at supply and demand side constraints, we still think fairly neutral on that. So we still, we're not expecting to see US inflation ticking up meaningfully from here. If you look at South African inflation, we're at the bottom of our band of 3 to 6%, sitting at 3% at the moment. So, the MPC did give us a 25 basis point rate cut towards the end of January. We'll take it. It's a nice bit of relief for the consumer, but ultimately fairly limited in terms of what we'd like to see there. But really, our bank's not going to start cutting rates too far ahead of the US. And if you look at the US, they kept their rates flat for the month of January. They citing inflation concerns going forward, but we don't think that's actually going to pan out the way they think it is. So, the fear now is that the Fed holds rates at too elevated levels for too long, and that starts to affect the economy. So something we're watching very closely. But ultimately, economic numbers still looking fairly strong. So we're still in a good position, but something we're watching, and hopefully that we can start seeing the Fed to cut rates there, and that'll also help us cut rates quicker on our side. Obviously, we need to protect the currency so we don't cut too quickly. But still, we'll take the 25 bips. On the Rand dollar, fairly, like if you look start to end, fairly flat, but quite a rough month, quite a volatile month through the month. I think with all the noise that was out there, so the rand initially strengthening quite impressively, and then weakening quite a lot, and then strengthening quite a bit again, and then weakening towards the end of the month. But on a net basis, it started at about 18.85 to the dollar at the beginning of January and ended at 18.65. So slightly stronger over the month. SA-US bond spreads picked up a little bit. So you're looking at a kind of spread normalization there. You've seen a bit of spread compression over the last few months, but that's normalized again, sitting in quite a healthy spread and looking quite attractive for SA bonds. In spite of all this, the ALBI still returned a positive 44 basis points for the month. So as I say, a positive month actually throughout equities and bonds. So that was quite good, even though you saw a little bit of a sort of kind of filling out of the yield curve, where you saw the sort of mid-dated and longer-dated stuff getting coming up a bit. So on the very long-dated maturities holding steady, and then actually coming down, obviously on the interest rate cuts news coming down on the short end, but it's kind of the middle of the curve, like filling out a little bit. But it's actually providing some good buying opportunities and good ways to rejig the bond portfolio a little bit. Then if you look at the G7 bonds, so that's the global G7 biggest economies in the world, also bonds up about 43 basis points there. So all in all, despite all the noise and rhetoric, and actually quite a good month for asset classes in general. But obviously, the things that we are watching very closely are just, kind of rhetoric around inflation in the US, around what rates are going to do, and then also obviously Trump's policies in terms of, how that's going to be perceived and seen across the world. So interesting times, but ultimately you got to look through the noise and look at the opportunities, and that's what we're doing well. But yeah, so all in all, a good month, and we'll keep you updated in what happens in February. As always, if you need anything from the team, please give us a shout, and we'll chat soon. All the best. Bye.